Markets maintained their positive start to the year as economic news flow again improved, particularly in the US, where recent distortions began to fade. Earnings seasons in the US and Europe continued to surprise positively, while positive inflows into equity funds were again a feature. M&A activity also picked up, providing further support. The inconclusive election results in Italy caused a temporary setback in markets, but they quickly stabilised and resumed their upward trend by month end. Through February, global equity markets were up 1.4%. Eurozone bonds gained 0.2% as German 10-year yields fell to 1.45% due to uncertainty post the Italian election. The euro weakened to 131 against the dollar due to the Italian election and the ECB highlighting the negative impact on growth of its recent strength. Contrary to pre-election polls, the outcome was a hung parliament in Italy, which gave rise to concerns that the reform agenda would be put at risk and might be seen as a backward step in terms of the European progress of recent months. Italian 10-year yields immediately jumped from 4.4% to 4.85%, and there was a flight back to safe haven assets such as German bonds. European equities fell about 2% at the time. The current expectation is that either some form of coalition will be established or a new technocrat prime minister will be appointed, which would enable the fiscal programme to continue to be implemented and a second election will not be required. The Italian annual fiscal position is actually relatively strong in a European context, with much of the hard work in terms of fiscal adjustment already done. And after the initial negative reaction, markets have begun to recover, with European equities now higher than they were before the election and Italian yields declining again to 4.5%. The outcome is unlikely to destabilise the move towards improved fiscal sustainability in Italy or disrupt the improving financial stability across Europe. Despite a debate at the US Federal Reserve over when and how quantitative easing might be withdrawn, comments by the Fed Chairman Ben Bernanke have reassured investors that an easing bias will be maintained for the foreseeable future. Additional easing is expected from the Bank of Japan, and with an increasing possibility of further easing also from the Bank of England, global monetary support is expected to remain in place, which is positive for the global economy and equity markets. In the US, there have been some concerns over the implementation of automatic spending cuts from the 1st of March, which could take 0.5% off GDP in 2013. At last, there appear to be some moves towards finding an agreement in relation to addressing the longer-term fiscal position in the US, and the level of automatic spending cuts are likely to be adjusted as part of these discussions. Any progress on these issues would be seen as positive developments. The outlook remains positive for equity markets. The risks which threatened markets through much of 2012 have reduced enormously and fundamentals have improved. Valuations, the economic backdrop, which is improving, continued monetary support, and increasing interest in equities are supportive. Events such as the Italian election are far less likely to derail markets compared to events such as the Greek election in 2012, given the policy initiatives since then. On the economic front, the US shows continued improvement, as does China, despite some recent distortions in releases due to the timing of Chinese New Year, while Japan is also showing signs of stabilisation. Business sentiment surveys continue to suggest the European economy will improve in coming quarters, although the UK remains sluggish. Returns from bonds overall are expected to be modest, but with opportunities still evident in peripheral markets.